Hi, I'm Dylan from FT Niger, and today I welcome you back to economic indicators and their impact on currency values. We're going to talk about gross domestic products, inflation rates, employment data, interest rates, and how they all intertwine and connect to make a very good fundamental analysis. So story time. Recently, in March, the House of Commons has released data that the UK's GDP has grown to $2.491 trillion. Very impressive figure. But that information alone is not actionable for the Forex trader. What he needs is to know whether, did the GDP grow or shrink in 2022? Is the GDP better than what was forecasted? Is the GDP of UK better than some other country like US? Let's look at the British pound US dollar currency pair. The US economy grew faster than UK economy, 9.1% versus 4.1%. And therefore, this means that cash was flowing faster into the US than it was into the UK, which translates to a stronger dollar and a decline in the pound US dollar currency pair. All this information was forecasted a long time ago. Weekly, monthly, and quarterly economic data is released on a regular basis so that key decision makers, including Forex traders, can make accurate predictions. Let's look at the current population survey conducted by the Bureau of Labor Statistics in the US. They release economic data on a monthly basis about employment statistics. The employment situation reports released in April 2023 showed us that the unemployment rates for US has declined to 3.4%. That's good news. That means that the US economy is healthy, and some measures that they are taking right now could possibly stop or slow down. So as you can see, understanding one economic data point, economic indicator, allows us to understand other economic indicators. Let's go into inflation. Right now, the US is battling inflation. In fact, the world is. With higher prices come less consumption. People are spending less. And if people spend less, companies are going to follow suit and cut production. As they cut production, what follows that is a loss in jobs, layoffs, and eventually recession. Thankfully, the US is not in recession yet because the inflation numbers have been better than expected. In March, it was 4.98%, but it fell to 4.93%. So that means that whatever they're doing to tackle this inflation is working. What exactly are they doing to curb inflation? They are raising interest rates. And by raising these interest rates, you can think of it as like a sponge in a puddle of water. By raising interest rates on government securities, they want to attract capital flows. They want to attract investors to buy these government securities, thereby soaking up excess money in circulation, which should, in theory, reduce the money supply and reduce inflation. So some better news is that the interest rates are probably going to slow down because the inflation rates have decreased. What if I tell you that from last year, when it was 0.25%, to now, where it's 5%, it has increased 20 times what it previously was. That's a lot. And that was a lot of action for fundamental traders to act on. Imagine the money you would have made if you knew that this interest rate that was at 0.25% now, in a year plus time, is going to be 5% upwards. I hope that you were able to understand this high-level overview of economic indicators, and understanding these indicators is what's going to make you a better Forex trader because you're going to have a better fundamental analysis going forward. See you in the next video.